Welcome to this presentation. Let's begin with an introduction to the topic at hand. We started by looking into some financial issues with the borrower. We found breaches in the cash sweep related to the interest coverage and debt yield ratios. Despite ongoing construction projects, the borrower's revenue was declining. A key concern was that project costs were rising, but revenue wasn't keeping pace. This was partly because the borrower invoices customers based on contract terms, no matter how much work has actually been done. To get to the bottom of this, we analyzed revenue trends for any unusual changes. We reviewed status reports from the lender's technical advisor to check how much of the projects were actually complete. Customer contracts were examined to understand how revenue should be recognized. We also verified that reported revenue matched the project financial model and assessed how this affected financial covenants and loan margins. Throughout, we engaged closely with the borrower's finance team to understand their revenue recognition approach. Turning to IFRS 15, paragraph 35b explains that revenue should be recognized over time when the entity's performance creates or enhances an asset that the customer controls during its creation. Since the borrower is in real estate construction and sells units before completion, revenue recognition should reflect the percentage of completion. However, we found that their contracts specify fixed invoicing amounts regardless of actual progress, which doesn't align with this standard. The main issue we identified was incorrect revenue recognition. Revenue from 3 construction sites was recorded based on invoiced amounts instead of the actual percentage of completion. This led to a revenue shortfall, with €0.9 million reported versus €1.2 million based on progress. As a result, key financial ratios were misstated, triggering a cash sweep breach that requires excess cash to be used for debt repayment. This misstatement also put the company at risk of breaching default covenants, potentially leading to lender scrutiny or penalties. To address these concerns, we engaged directly with the borrower's management, holding discussions with their finance team and project managers to clarify policies and controls around revenue recognition. We escalated our findings to the credit risk and lending teams and recommended corrective measures, including aligning revenue recognition with IFRS 15 based on percentage completion and adjusting financial covenants as needed. We also proposed strengthening ongoing monitoring through more frequent financial reporting and early warning indicators to catch future discrepancies. In conclusion, the borrower agreed to adjust their revenue recognition to comply with IFRS 15. This led to revised financial metrics that improved compliance with interest coverage and debt yield ratios. Ongoing monitoring was enhanced with updated covenant terms requiring quarterly financial reports. Additionally, internal monitoring processes were strengthened to detect early warning signs and prevent future breaches. Thank you for your attention.